Okay, without further ado, let's start our webinar for today. So yeah, let me introduce myself first. Okay, so good morning, everyone. Thank you for joining our webinar today. Hope everyone of you are doing well. My name is Ng Ka Fong. You can call me Brian. I'm from Phillip Futures Kota Damansara. I'm from marketing department, and I'll be the speaker for today. So during the webinar, if you have any questions, do type them into the question box down below, and I will address the question during the Q&A section and at in the end of the webinar lah. Yep. So hold on, yeah. So let's go to our disclaimer first. As usual, I need to emphasize on our disclaimer where this presentation has not been reviewed by Security Commission Malaysia and is provided to you solely for general information only and does not constitute any recommendation. We are not liable for any losing arising based on this kind of information. So investment are subject to investment rate. Therefore, you shall seek for an advice from a qualified advisor before making any investment decision. So about Phillip Futures. Phillip Futures is a wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd. It's incorporated on 7 October 1995. Our headquarters is in KL branches, and also we have few branches distributed across the Malaysia, such as KD, our branches, Malacca, Penang, Johor, Kuching, Cebu, and also newly opened KK branches. Other than that, Phillip Futures is a trading participant of Bursa Malaysia Directive Berhad, clearing participant of Bursa Malaysia Directive Clearing Berhad, and also holder of Capital Market Service License, also known as a CMSL. So I would like to take this opportunity to extend our gratitude on behalf of my company, Phillip Futures, to our clients. Without you, we are unable to achieve the awards. In 2020, we achieved 3 awards from Bursa Malaysia: the best overall, best retail, and also the best institution derivative trading participants. So about our global network, as you can see, our mother company Phillip Futures has office at different kind of country branches over the 14 different countries. As you can see on the presentation slide, there are US, France, Turkey, India, China, Japan, Vietnam, Cambodia, Australia, Singapore, UK, Dubai, Indonesia, Thailand, and also Malaysia. About our coverage, our global coverage for futures, we cover not only Malaysia products, we also cover all the different exchange such as Singapore Exchange, CME, CBOT, NYMEX, or more. With our strength of global coverage, client able to trade both local and also foreign product under the same platform, which is Phillip Nova. Maybe later I will explain a bit on the platforms. So the product that Phillip Futures offers are basically we offer futures and also contract for difference is called CFD. For futures, we did offer index futures, metal futures, agriculture futures, and energy futures, and also interest rate futures. For CFD is most likely can compare with some shares, but we are just doing different kind of market as Bursa Malaysia, New York Stock Exchange, and also Nasdaq, as you can see, as National Association of Security Dealers Automotive Quotation. So why should you choose Phillip? First of all, we provide advisory service such as enquiries. Next, we provide wide array of product for futures that enable clients to trade both local and also foreign products. Other than that, we send out the latest market news and commentary to our clients every day through email for reference. Lastly, our headquarters have 24 hours broking and execute support. This is important for clients who trade foreign futures, and also dealer can assist you inquiry anytime. So we did provide kind of service, no matter no matter you are our clients or not. We did offer one-to-one coaching to our potential client, or you already is our client. We also offer free seminar and webinars like today's. Lastly, we did a free account opening also. So basically, let's go into our topic for today. So for today's webinar, we are going to talk about how to get started on futures trading. For those who are just came in, I would like to introduce myself again. My name is Brian, and I'm a dealer marketing executive at Phillip Futures, and my Phillip Futures branch will be Kota Damansara. Yep. So today webinar we're going to talk about what is futures trading and how does futures trading works. The second, we're going to talk about why choose futures trading, and then third will be factors affect Bursa Malaysia KLCI futures and also crude palm oil futures, as we know as FCPO. The fourth will be basic technical analysis, and last will be mechanism of futures trading. For our first topic, what is futures trading and how does futures trading works? So for futures contract, what is futures contract? Futures contract is a legal agreement to buy or sell a particular commodity asset or financial instrument at a specific time, specific date for a specific price in the futures. Yeah, basically you can saw an example at the slide there. Let's assume that you are a farmer right now, and then you want to sell your corn to maybe a client or customers in the futures. So you can sign a contract to make a contract, both agreements for the buyer and the seller. You sell to him in the futures with delivery date, quantity, and also the price have been fixed on the contract. But for nowadays, future contract are standardized agreement that typically trade on the future exchange that allow investor to trade for the futures contract, not just the farmers to do the futures contract trading. Yep. So for the type of futures product, basically we have four kind of futures product. First one will be agriculture's futures. As you can see, the example there is a crude palm oil, which is the oil that you often the factory used to produce some oil for the eating, for the food and beverage or something. So there is a crude palm oil, soybean, wheat, and also corn. Next will be index futures. As we know, index for Malaysia will be KLCI. In the futures, we call it FKLI, S&P 500, SGX Hang Seng Index, and also China A50 for China Index. The next will be metal futures. As we know, metal can be called at gold, silver, iron, and so on. Lastly will be the energy futures. Energy futures will include crude oil, natural gas, and gasoline. Next will be the futures contract standardization terms. Basically, there is four elements for, basically there is four elements for the futures contract. First is underlying asset. Underlying asset will be what kind of asset that the futures contract will be. Let's for an example, if FCPO futures of a crude palm oil, the asset will be crude palm oil as well. Let's say there's a FLGD and the underlying asset will be gold as well. So the quantity, for the quantity meaning that increase by 1 will equal to how many quantity. We'll provide an example later on the coming slideshow. So the third one will be expiration. Expiration also can call it as a maturity date. Expiration will be when the futures contract be expire. Let's for an example, if you purchase a March futures contract right now, and the expiration date might be on March for the next years. So that will be the expiring date for futures contract. So the last will be the price. Yeah, the price meaning that how much the future contract are currently pricing at. So next, let's see about the settlement. Yeah, as the slide you can see that there is a cash settlement and physical delivery. So for the cash settlement, at the end of the contract, holder of the position is simply debited or credited the difference between their entry price and also the final settlement. For example, for cash settlement futures, there's a KLCI, FKLI futures for KLCIs. S&P 500, Nasdaq are receiving the cash one. So for physical settlement, there's different can't compare with the cash settlement. Physical delivery, meaning the end of the contract, holder of the position will either have to deliver the physical commodity if in a short contract, or receive the delivery if in a long contract. Okay, so physically settlement is when the end of the contract will receive the actual commodity like gold, crude oil, palm oil, and so on. But do not have to worry, because as a clearinghouse like Phillip Futures won't let these kind of things happen to the clients. We will we will contact the client before the maturity ends, and then we will ask the client, would you want to like maybe close your position or something else. It make it become back to a cash settlement. Yep. So next, so this is a very good example for a standardization contract specification. As you can see, the product here is BMD FCPO. So the underlying asset will be crude palm oil. So what does the contract size mean? The contract size 25 metric ton, meaning that let's assume that currently FCPO price is in 5,000. Contract size for one will be 25 metric tons. So the total contract value will be 125,000. Yeah, so to basically contract size will be determine the contract value lah. So for the minimum price fluctuation, as you can see for BMD FCPO, which is future crude palm oil, is 1 ringgit per metric ton. So for the contract size, there is 25 metric ton, right? So for 1 ringgit for 1 metric ton, so 25 metric ton will be 25 ringgit lah. Okay, let's assume that market price now is at 5,000 for FCPO. So when the price, right, it goes against it goes in your favor, which is, let's assume that you're holding a buy position for FCPO, it increased 4 points, so you will be earning for 100 ringgit, because this one tick equal to 25 ringgit, so 4 tick will be equal to 100 ringgit. Let's assume that that's against your position, it dropped to 4996, you will be losing 100 ringgit as well. So as I said just now, for the previous slide, there is a settlement. So for FCPO, it will be physical settlements, and the final trading date is the expiry date or maturity date for the contract. So the contract expired at the noon of 50 date of the delivery month. Let's assume that this is a March contract, so it will be expiry at 15th of March. So for the trading hours, as you can see, there's 3 trading hours. The first is first section, 10:30 to 12:30. Second section, 2:30 to 6 p.m. And the last one will be after hour trading section, with the T+1 that newly announced by BMD. Is from the 9 to 11:30 at the night. So the last one will be initial margin. So what is the initial margin? Initial margin basically is meaning that how much you have to hold for a contract. So let's take this as an example. Let's say you want to hold a BMD FCPO, which is a futures crude palm oil contract. You have to pay for the initial margin, which is 7,000 ringgit in order to hold one contract. Yeah, basically that's all for the futures contract. So why choose futures trading? I think many kind of us like an investor for the new for futures, you would think that why people should choose futures trading rather than stocks. Stocks provide maybe high returns or what. But in futures, there's 4 kind of elements. Why people trade futures contract? First is the leverage. Second is high liquidity. Third is bi-directional trading. Fourth will be low transaction cost. Let's go to first one, which is leverage. Okay, so what does the leverage mean? Leverage meaning that use smaller capital upfront to trade greater value of contract. Normally 5% to 20% of the full contract value as for futures. And then the third one will be small movement in the market can translate into big movement of your portfolio. Let's give you an example here. As we said just now, the initial margin of FCPO futures crude palm oil is 7,000 ringgit, but what does the contract value really is? So for FCPO, let's assume that FCPO now is trading at 5,000. So one contract equal to 25 metric tons. So the total contract value will be 5,000 times 25 metric ton will be 125,000 ringgit. So as you can see, by using 7,000 ringgit, you can invest in 125,000 of investment. That's kind of like you're just using 7% of the money in order to invest in 100% of things. So let me give you some example for leverage. Okay, let's assume that you now had purchased an FCPO contract, and then the market goes up, and then you sell the FCPO at 5040. So you are selling a greater of 40 points. So 40 points, as you can see, the 40 point times 25 metric tons, which is 25 ringgit, and you can get a gains of 1,000 ringgit. Let's assume that you are doing it in a spot market with a physical market. The contract value now is 125,000, and the return of investment will be 1,000 divided by 125,000, which is 0.08%. But let's assume that you are invest in a futures market. In futures market, when you are just paying the initial margin of 7,000 for FCPO, the return of investment can goes up to 14.25%, as much as that. As you can see, compared with the spot market, which kind of return that you are chasing for, you would like to get 0.08% or 14.28%. So basically, you can see that the spot market are earning lesser than the futures market, which spot market are just earning 0.08 and the futures market are 14.28. But what I can say is leverage might make you happy, but it's also a double-sided sword for you. So let's go to the set example, which is the loss example. So let's assume that you now have a FCPO at 5,000. The markets go down and then drop about 30 points. So as you can see, 30 points times the metric tons, 25 metric tons, as you can see, you will be losing for 750. So in the spot market, which is called the physical market, the contract value is the same with just now, 125,000, and then the return of investment or loss of the investment will be 700, 500, 750 divided by 125,000. You will get a negative 0.6%, which is loss 0.6%. But in the futures market, leverage maybe is a good thing for you, but you also have to beware, because in futures market, the initial margin of 7,000, and then the return on investment will become loss of 10.71%. So as an investor, we have to be aware on the loss potential of leverage. While the spot market losing 0.06%, but the futures market might lose beyond 0.06%, which is 10.71%. So this might be a interesting topic. Maybe in the futures, we have a one-to-one coaching session. We can discuss more about on this. So we go to next characteristic for futures. Yeah. So the next will be high liquidity. As you can see on the how to say, on the tables there, you saw the volume there. The volume is determined how much the people are trading or often trading for the futures contract lah. So as you can see, there's 21444 for the FCPO and also 4958 for the FKLI, which determine that this is quite a lot of people trading in the futures market now, compared with some of the stocks. Maybe they in a day they just like trade for 10 lots, 20 lots or something else. So high liquidity may bring benefits to those investors who like to do speculating. Speculating, we will discuss more about it on the coming slide. So let's go to bi-directional trading. So for all the investment, people are allowed to do long in futures. In futures, we call it long, but in a sense, to let you more understand, we call it buy first. You can buy the futures contract and then wait, the price goes up and then you sell and then get a capital gain. But what does the bi-directional trading meaning? Bi-directional trading meaning that you are allowed to short selling for the futures as well. In Malaysia stocks market, not all the stocks are allowed to short selling, which is you buy at a high price and sell at a low price in order to gain a profit. So in the futures, it might be a win-win situation for during bear market or bull market. So for futures trader, they don't have to worry about, oh, the current market is not doing very well, so I have to stop to trade. Maybe after it come back to bull markets, then I enter to the market or something else. In the futures market, you don't have to like worry about this because when during the bear market, the futures investor are allowed to gain profit from the bear market as well. So sorry. So for last one will be low transaction cost. Let's take an example of futures market and also stock markets. The futures market that we take is FKLI, which is a KLCI index. So for the contract value, let's assume that the contract value now is one contract is equal to 1,005, which means 75,000, and then compare with the equivalent share of 75,000. So let's see the transaction cost for intraday. So for the brokerage fees for futures, I just have to pay 50 ringgit. Stamp duty and clearing fee are waivable, which is you do have to pay any stamp duty fees or clearing fees. So the total commission pay will be paid to the exchange will be 30 ringgit. But for the stocks market, as you can see, the brokerage fee are 0.03% times the contract value, and then stamp duty is the same. Clearing fee is at 0.02%. As you can see, in the end, for futures, you just have to pay for 30 ringgit for a contract. But for the stock market, you have to pay about 465 ringgit. So definitely for you, what kind of fees that you more interested, more attract you to pay with? Of course, all of us don't like to pay, but I would choose 30 ringgit for sure, rather than pay 400 ringgit. Yeah, so this is the last benefits of trading in futures contract. Let's go to our next topic, which is who trade futures. Okay, so basically there are three types of futures trader in the derivative markets. The first one will be Hedger, second one will be Speculators, and then the third one will be Arbitrators. Let's talk about the Hedgers first. Hold on, sorry. So let's talk about the Hedger. Hedger, what does the Hedgers mean? Hedger is to manage the risk and uncertainty of the financial instrument or commodity contract fluctuated. Fluctuated meaning that maybe the price is not that constant. We will go up and go down. So hedges will refer to the first one is the commodity producer. So how does the commodity producer reduce the downside risk? Basically, if you are a producer, the thing that you afraid will be the price of your product. Like let's take an example like corn or wheat decrease, and you will face a sufficient loss due to the decrease. So hedging play a quite important role to reduce the risk of it by purchasing a short contract. So in a short contract, right, you are allowed to sell at a high price and then buy back at a lower price in order to like balance back the losses that you are facing. The product of your price of your product gain losses in the futures. So for the second one will be wholesaler, retailer, and also manufacturers. So basically for wholesaler, retailer, or manufacturer, they were deemed to not have a higher cost on their raw material, as we know that futures are there's metal futures in futures contract. So there's kind of like a raw material. So in order to let those raw material increase price, so the hedging for wholesaler, retailer, and manufacturers are just an opposite of commodity producer. So they will purchase a long futures contract to buy low sell in the high. So let's assume that in the futures their raw material get increased by maybe 1%. In the future market, in the 1%, there will be how to say, to balance it back the losses from them lah. So lastly will be portfolio holder in cash markets. Okay, basically portfolio holder in the cash market, meaning that you are trying to hedge if the market against you lah. Let's assume that now currently you are holding maybe 10 stocks, and then you can, how did the investor are holding 10 stock to hedge against the portfolio? So in order to hedge against the portfolio, the investor could short, which is sell the FKLI contract, futures contract. So when the investor portfolio has decreased, it will be gaining from the futures lah. Yeah, so basically this is the hedger. Let's go to the next. It's the speculators. I believe all of the person here, all of the attendees here, most of us are speculators, because including me, I am a speculators also. So what does the speculators mean? So speculation is a common market activity that participants of a financial market take part in. Speculators are investors or traders who purchase assets or short period of time and employ strategy in order to profit from their change in its price. Speculators bring liquidity and assume market risk, which makes them the important player in the market. So what does speculator really mean? So speculator trade based on their education guesses on where they believe the market is headed. For example, if a speculator think that a gold commodity is overpriced, so they may sell, or you can call it short the gold futures and wait for the price to decline in order to take profit from there lah. So as you can see from the slide, there's someone called Mr. Speculators. Mr. Speculator say, the price has been going up and there seems to be heavy buying. I will buy it at 200 ringgit, $200 maybe. Later I should able to sell it for maybe 250. Yeah, basically this is how the speculators do. They predict a price and then sell it in the futures based on their education. Let's go to our last investor, arbitragers. Arbitrager is a little bit complicated, but let me explain a little bit to you first. Arbitraging involves buying at the lower price and sell it at a higher price in the market. Arbitragers take benefit from the price difference in two different markets. You may ask, how comes the people buy in the market and sell to another market? Basically, in let's say in the stock market is not achievable, but in the futures market is achievable. Let's give you an example. For example, as you can saw the picture beside, let's assume that the arbitrager saw a price difference from two different markets. They will purchase from the market A and they sell it to market B in order to gain profit from two market different prices. Let's assume that the investor buy gold from Malaysia and then sell the gold for Singapore. Let's assume that the investor buy 1,000 ringgit of gold and then sell 1,002 for Singapore in order to gain the profit. So basically this is how does the arbitragers work. Yep, next slide. Okay, let's go to our third topic. So the third topic will be factor affecting FTSE, Bursa Malaysia, KLCI futures, which is FKLI, and crude palm oil futures, which is FCPO. Just to inform you guys, those two contracts in Malaysia are the most famous in Malaysia. There's this example that I show just now. There's high trade in volume. So let's assume that in the futures you are trading in, you like to trade in Malaysia derivative market. You can choose for these two contract for beginners because it is quite how to say, user friendly. Okay, so for FKLI contract specification, before we talk more about what does effect on what effect will change the price of FKLI, let's study about what is FKLI first. So as you can see, the product is FKLI. So the underlying instrument is what? So the underlying instrument will be KLCI, which is the stock market for Malaysia. So the contract size, the contract size for KLCI, I'm sorry, there's a typo. The contract size for FKLI is multiplied by 50 ringgit. Let's assume that the contract size now is currently at 1,500. So you have to like times 50 ringgit in order to get the true value of the contract value. Yep. So for the minimum price fluctuation, it is a little bit different for FCPO, that an example that we showed just now, because FCPO are a physical product and FKLI is an index futures, so it does not have any physical product or what. So the minimum price fluctuation for 0.5 point, it will fluctuate, it will increase or decrease by 25 ringgit. Okay, get back the example from the contract value. When the market price now is trading at 1,005, so when you are holding a FKLI contract, when the price go in your favor, which is increased 2 points, you will earn 100 ringgit. As you can see, the minimum price fluctuation 0.5 is 25. So 1 point is 50 ringgit. So 2 point will be 100 ringgit. Let's assume that the price are against you, which is the position against you. It's dropped 2 points, and also that will make you lost for 100 ringgit as well. So for the settlement, in yearly, we say that there is two settlement. One is cash settlement. The other one is delivery settlement. So for FKLI will be cash settlement. The trading hours are likely same with FCPO, but a little bit of different on the first section because it opened earlier on 8:45 a.m. to 12:45 p.m. And then the second session will be 2:30 to 5:45. And then after hour section is the same with FCPO, which is 9 to 11:30. So the final trading date is also a little bit different compared with FCPO. The last business, the final trading day will be the last business day of the contract month. Let's assume that in February end is 28. So the final trading day will be February 28. So initial margin is also different because the contract value are a little bit different compared with FCPO. FCPO is higher than the FKLI. So initial margin will be required lower than FCPO, which is at 4,200. Yeah, after we know about the contract specification, let's see what does the FKLI really means. So the FTSE Bursa Malaysia KLCI represent the top 30 companies by market capitalization on the Bursa Malaysia main market. As you can see, FKLI does not represent the whole market because maybe there's a kind of like unstable for the whole market. So FKLI picked the highest 30 company, which is a blue chip company in Malaysia, in order to like make a benchmark for FKLI. So as you can see, the company included Axiata, CIMB, Dialog, DG, Genting Malaysia, Hapsing, Hartalega, and so on. As you can see in the slide, right? Those company, I believe, we are quite familiar with all those company lah. Oh, the time is running off. Let's go a little bit faster because the time is really not enough. Okay, so for the factor may affect FKLI, this may be important for all those investors who are new to FKLI. So the first one will be interest rate. Hold on. Okay, so the first one will be interest rate. Interest rate meaning that Central Bank of Malaysia cut off the overnight policy rate to make the lower interest rate. So the overnight policy rate will affect the whole market because when the interest rate is unstable, people will tend to not invest in the market, so makes the FKLI markets to maybe drops or increase. So the next one will be oil price. Since Malaysia is the largest crude oil supplier for ASEAN country, when the demand for oil increase, it might have a positive impact on the FKLI market as well. So the third one is the most familiar one, which is the COVID-19. Yep. So pandemic uncertainty will make FKLI become unstable And based on the past data, COVID been pushed to the 1,003 point and reached the 10 years low, mainly because of the most of the business are unable to continue their business due to lockdown, and also the spending power of the public was decreased due to the COVID-19. So it may affect the FKLI to be decreased. Lastly will be political uncertainty. So political uncertainty will bring public investor less comfortable to the market, and politicians may come out some political policy that may influence the market as well. So next will be FCPO. The FCPO contract specification we did cover just now. So maybe let's skip because the time is quite not enough. So let's go to the factor that may affect FCPO market. Hold on. Yep. So for the factor that may affect FCPO market, the first one is the weather season. So as we know, FCPO, crude palm oil is a plant. Yeah, it's a plant. So the weather will be affect a lot on FCPO. Palm oil is a tree that require warm weather, so it will be more productive. So, but very luckily, Malaysia are located in at a very warm places and humidified. But there's a weather called La Nina, which is a rainy season, and also El Nino, which so-called a warm season. So during the El Nino, it might better for export for Malaysia because it is a warmer. So that maybe Malaysia will produce more FCPO to export to the other country lah. Since we have touched a little bit on the export, let's talk about the FCPO import and export volume for different countries. So as you can see, the top producer is Indonesia, Malaysia, and also Guatemala. The top consumer of FCPO country is in India, China, and Pakistan. Okay, export from country will affect the supply of the crude palm oil. And import of those three countries will also affect on the demand because when the demand increase, but the supply is not increased, so the price might be gaining lower and lower. Let's assume that more people want purchase FCPO, want to purchase crude palm oil, but the demand for crude palm oil are not that much, so there will be an increase in FCPO lah. Yep, so go to the next one. The next will be competition from another edible oils, which including sunflower oil, corn oil, and also soybean oil. Okay, once one of the compatible oil decrease in price, that might bring a negative impact for FCPO because people will deem to buy that oil rather than FCPO, just like Gardenia and Massimo. Let's assume that Gardenia now is selling at 1 ringgit. Let's assume Gardenia is selling at 1 ringgit. Suddenly Massimo say, oh, we're gonna sell our Massimo bread in 90 cents. Also, everyone we're gonna to buy Massimo rather than Gardenia. So Gardenia have to bring down their price. Just put the example into FCPO, crude palm oil, and also sunflower oil. We will do as well. So lastly, will be the festive season. Yeah, festive season, the most happy for all the Malaysia would like because it's a holiday. Yep. So for the festive season like Lunar New Year, Deepavali, and also Hari Raya, they might increase the demand of FCPO because FCPO will produce like the oil to the public and then to let them cook or something else. So during the festive season, there might be a slightly increase on futures for crude palm oil. Yeah, so goes to our fourth topic, which is basic technical analysis. So as you can see, for technical analysis, there is a very important things, which is the candlestick. On your left side, which is the green candlestick, is a good sign for everyone. Maybe it's a bad sign for those who short the contract. But the candlestick is used to determine the price of the day, hours, or even a minutes. So as you can see, there is a high, close, open, low, high, open, close, low. Basically, when you saw a green candlestick, which means the price are increasing. When you saw red candlestick, which is meaning that this is bearish in the markets currently lah. So the next will be support and resistance. So support meaning that reaching the lower price and try to get a rebound. And then what does the resistance really mean? Resistance meaning that reaching the peak of the price and might getting a readjust for the price. So as you can see, support and resistance are quite important because it will form something called channel. So what does the channel really, how does the channel form? So when there is the combination of resistance and support, they might create a thing called channel, and it will create a sideways for the price. And this is the most simple way to predict the price using a channel. So as you can see, in the channel, for the support line is kind of like the borderline, and then the resistance is kind of like the peak for the maybe let's assume that this futures FCPO. So when it reach support line for the channel support line, you may deem to like buy the contract, and then once it reach the resistance line, you will deem to sell the contract in order to gain the profits. So there's different kind of channel but for today we are just quite short of time. We just going to discuss about the uptrend channel. So this chart show the channel might become an uptrend channel. When an uptrend channel might be consider a good time to invest, but we also have to aware that there is an adjustment of the price while break into the support line, because in this situation, after the breakthrough the support line, the price is dumping to a lower and lower. So how does investor to cut loss? By placing different kind of orders. So it will relate to our next topic, which is mechanism of futures trading. So the first one we'll be discussing about the order types. So the first order type will be market order. Market order is buy or sell at a current market price, which means let's assume that currently, okay, let's discuss about what is bid and ask first. So the bid price represents the maximum price that the buyer is willing to pay for the securities or the futures. The ask price represents the minimum price that seller willing to take for the futures. So in the market order, let's assume that now you buy the market. When you buy the market, it will automatically fill into the ask price, which is 4205. Vice versa, if you sell the market, it will automatically goes to the 4200. If let's say you place a market order to buy the market, so it will fall into 4205. Yeah, so basically this is the market orders. Next will be limit order. Limit order is meaning that buy or sell in that selected price. Buy limit is meaning that order price is lower than or below the current market price, which is called ask. The sell limit is that order price is higher or above the current market price, which is bid. So let's assume that currently you want to buy limit. Why you want to buy limit? Because currently you are holding a short position for futures contract. So for short position, you would like to the futures contract drop into a certain price. So in this situation, you can use the order limit to set at 4190 in order to gain 10 ticks from the futures contract. So vice versa, let's assume that now you're holding a long contract for futures. You will set a sell limit at 4210 in order to gain 10 ticks of profits. So the next one will be stop orders. Okay, stop order is to minimize a loss on long or short position. So for buy stop, it's meaning that the place higher above the last done price. Yeah, as you can see, let's assume that you're holding a short position. So short position, we will you will want the price go down, because when you go down, you make a profit. So you can place a stop order in order to let you to stop loss. So you place a buy stop when you are holding a short position at 5020 in order to get 20 ticks of losses. So same to sell stop. So for sell stop, when you are holding a long position, for the stop losses you are setting to 20 ticks, you will set a sell stop at 4980. Yeah, basically this is all the order types. So let's go into the margin call. So margin call is quite important for futures because margin call happens when the investor do not have enough account balance to hold overnight. Let's assume that you are holding overnight. So the initial margin for FKLI, which is a maintenance margin, initial margin for FKLI is 4,200, as we say that earlier on the contract specification, but the maintenance margin for FKLI will be 100% of the initial margin. Okay, let's assume that if currently your equity balance is 4,000, with the trader or investor will receive a margin call, and why? The answer is yes. The investor will receive a margin call because the current equity is lower than the maintenance margin, which is 4,200. So the investor will receive a margin call. Let's give you another example. Example for margin call. In day one, you long a FCPO contract at 5,000, which is buy, and then suddenly it dropped to 4,980, which is drop of 20 points. You will lose 500 ringgit. So in day two, you're holding a FCPO contract, right? So the cash balance will be 7,000 minus 500 that you lost yesterday. So the cash balance will be 6,500. So when the cash balance is less than the maintenance margins, you will receive a margin call of 500. So basically, this is how does the margin call did happen. After you may ask, after I receive the margin call, what should I do? So basically, there are three ways in order to answer the margin call. The first one is deposit the margin call amount to stay the contract maintenance margin, which is 7,000. So you have to deposit 500 in this situation. The second one is the cash buying power remaining to become positive before the market close. In day two, let's assume that yesterday you dropped 20 points, right? Let's assume that in day two, the market rebound in your favor. Let's assume 30 points. So you go back to maintenance margin. So you are not, so you will, how to say, so we will not we will not liquidate your position because it's getting back to maintenance margin. Yeah, so for the last one is to liquidate your position. That's the most easiest way to make your contract loss stop at 500. So liquidate, and then there will be no more margin call. Yeah, so I think that's all for today. But before we go, let's have a quick recap on today's webinar. So how to begin to trading with Phillip Futures. First is to open up an account. The second will be know your risk appetite, which is you are willing to take more risk to gain more profit or what, and then to study the product of your interest. Let's assume you are interested in Malaysia product, so maybe you can focus on FCPO. So after that, you should understand fundamental analysis and also technical analysis, and then start your trading journey. Make sure you are always up to the date of the market news. Keep learning and happy trading. Yeah, basically this is a few steps that you should follow as our advice. So for the Q&A section, if anyone have any question, you may type on the question box below. I will try my best to answer those questions. Yeah, maybe I give you maybe 3 minutes. Yeah, while you are filling the questions, let me introduce some things to all of you guys. So we have successfully launched the first futures trading online account opening in Malaysia. So you can now open futures trading account online with no hassle. If you wish to open futures trading account online, feel free to visit our website or by just scanning the QR code at the above. If you have any guidance on online account opening, please do not hesitate to contact us. Okay, so for Phillip Nova that we have showed just now, let's explain more about Phillip Nova. So basically, the Phillip Nova is the platform for futures trading in Phillip Futures, which is commonly used by our clients to access global product. For desktop version, it's a web-based platform, but for mobile version, you can download it from the App Store or the Google Play Store. So it allows you to trade anywhere that you want at any time. So we are also offer a Phillip Nova demo account. As you can see, there's a QR code there. You can scan the QR code and then try our platform in advance. So for campaign wise, we are currently having a campaign called Phillip Star Trader. Basically, this campaign allow our clients to gain point while trading with Phillip Futures, and the price of the campaign including Rolex voucher worth 35,000, Apple voucher worth 10,000, and also gold worth 5,000, and so on. So you may also scan the QR code above on the screen in order to fill up a form, and then our representative will contact you as soon as possible. So this is all you can connect with us now on Facebook, LinkedIn, and YouTube by just searching Phillip Futures Sdn Bhd, on Telegram by just searching Phillip Futures. So do like and share and subscribe for all our social media platform. Thank you. Yeah, so this is our contact for Phillip Futures Kota Damansara. Feel free to contact us. Yep, so let's go back to Q&A section. Okay, so the first question I saw here, in general, it's correct to say that increase in the price of soybean will lead higher demand and price of FCPO. As we said just now, soybean and CPO is kind of like a brother sister. They would like to chase for the same goods. So let's assume that increase in price. Okay, so let's assume that soybean now increase in price. People will more tend to purchase more on crude palm oil, because let's say I give you Massimo and Gardenia. Now Gardenia increase 1 cent, and then we will purchase on Massimo more than Gardenia, right? Yeah. So this is the how does the things works because they are both competitors. So the next questions to make some. Okay, the next question will be currently maintenance margin for CPO is 100% of initial margin. I would say yes. Yes, for all the futures contract now are at 100% of the initial margin, but sometimes there's a waivable choice, but you have to like fulfill the company needs. Let's assume that for Phillip Futures are allow our customers to hold the 100% of initial margin becomes 50% margin, but you have to like fill some specification on your balance yeah. So no much more question. Let's go to our last questions here. To make a stop limit, can I set the amount? So for the last question, how do I register for one-to-one coaching? Yeah, so basically for one-to-one coaching, you are just, maybe you can go to Google and then search Phillip Futures, and then you will pop into a website, which is our official website, Phillip Futures website, and then go to learn, and then go to one-to-one coaching section and register there. So, and then after that, our representative will queue up and timetable for you, and then we will have a one-to-one coaching section. Yeah, any more question? We still have 4 minutes here. If you have questions, feel free to ask on the question box, yeah? Maybe we wait 2 more minutes to let the audience to ask some questions if they want. You missed the beginning part. Okay, from Mansin. No worry. For the beginning part, you can After this, we will send a thank you email for all the attendees who attend today's webinars, and on that email we have a YouTube record which is recorded this webinar, so you can check out there lah. Okay, if no more question, I think we will end our webinar today. But last but not least, feel free to contact us if you have any questions. So this is our contact. Oh, sorry. Yeah, this is our contact for Kota Damansara branch. Yep. So thank you everyone. So do contact us. We will happy to assist you lah. Last but not least, check out our promotion and grab the opportunity to join it because it's end of the year already. Our campaign is on the borderline of for this year. So thank you everyone for joining today, and then yeah, have a good day and bye bye.